In this video, we are going to go over the best trading strategy that you can use when you're trading gold using ICT concepts during the New York session. So without further ado, let's get started. So the first thing you want to do is you want to come over here and you want to click on this button and make sure that your time zone is set to New York. So I'm based in London, but what I've done is I've gone and clicked this, and now I'm ready to get started with this video. The second thing you want to do is you want to come to the charts, and I'm going to just mark this out using some rectangle boxes, and you want to come and you want to look at the daily time frame. Okay, so I've drawn a rough candle here. This is the daily time frame candle, and what you want to do is as soon as you come here, you want to mark out the high and the low of the candlestick, and we're going to be using wick highs and wick lows. Now this is very, very important. And the reason why we do this is because we want to see if price is going to raid the liquidity below this low and above this high, because as we know, for daily candlesticks as well as weekly candlesticks and obviously monthly candlesticks, that there is liquidity below the highs and lows, and price is likely at some point during the week, during the day, during the session possibly, that price is going to go ahead and raid these highs and lows. So that's step one. Essentially, you're going to come to your charts in the mornings, you're going to look at your previous daily high, previous daily low, and see if price has taken it, and if it hasn't taken it, we're going to mark the high and the low out. Now the second step involves us dropping down from the daily time frame all the way to the 5-minute time frame. So what we're going to be doing is we're going to be looking and monitoring price action. Okay, so let's say price action is just moving like this, and then what we're going to be looking for is we're going to look for price to raid this low. Okay, we want that raid of the low or raid of the high. In this example here, we're going to go over a low because I just want to go over it really nice and simply with you. But essentially, we want to see this low be raided, and then we want to see price pull back in to within the high and low range of the daily candle. And at this point here, we're going to get two things happen. So the first one is going to be, when we were coming down, we created structure that price grabbed liquidity from, pulled up, and then pulls down and then moves up. Now bear in mind, the leg that pulls back into the range has to have a fair value gap in for us to enter from. So whether it be an extreme one or one around here somewhere, we need to get that. We also need a break of structure from here to there, and that's going to be our first entry model. Now the second entry model is a bit more different. It's something that you probably haven't seen before, which is basically when price comes down like this, it doesn't create structure, but it does grab liquidity from below the daily low or above the daily high. And so in this case, what we're going to be doing is we're going to be waiting for price to pull back in, then we will wait for price to react, and we're going to try and get in on this move. So not the first move, not the first pullback, the second pullback into this leg here. So we're going to grab into a trade here, and then we're going to take it to the high side. So essentially, we're looking at trades like this, stops below, and we're going to aim for a 1 to 3 or a 1 to 5. That's up to you. It works for both of those. I always aim for a 1 to 5. You can aim for a 1 to 3 as well. And then obviously here, let's just do this, and let's just say we're going to aim for a 1 to 3. Stops have to be below the nearest swing low or swing high if you're taking shorts, obviously. So that's what it looks like from the, taking a trade to the upside. Then if I just invert the scale, that's what it looks like to the downside. So it's very simple, very easy to understand. There's not much you need to do. There's no daily bias that is required, because we're looking for a sweep of the previous daily high or daily low. Now bear in mind, it doesn't have to be yesterday's daily candle when we're trading today, sort of thing, right? It can be the day before's or a previous day's. We just want to make sure that price is going to raid that low and look for a reaction if that price or that daily candle's high or low gets raided. So without further ado, let's go into an example of this. Top. Okay, so let's go and have a look at this example here. So I'm on gold, I'm on the daily time frame, and the first thing, as I mentioned during the example, is we just want to mark the low and the high of the previous daily candle. So obviously we're going to be trading on the 14th of August on Wednesday, so we're looking at Tuesday's price action. When we have candles like this that are big and bullish and moving to the upside, we generally know we're not likely to get one of these trades where price is going to wick down, take the low and then move up, or wick up, take the high, then move down. It's something that generally doesn't happen, and especially when price closes with such a small wick like this, I wouldn't be looking for this type of trade. But what you want to be looking for is something like this, right? Look, if we look at this daily candle here, we've gone low, we've gone high, but then price wicks up and wicks down. So you're looking at possible trades here. Let's go back further. We'll probably see something else where price has done something very similar. I'm guessing here we've got a bit of a nice wick here, so we can count this one. Price comes in and then we get some sort of movement to the upside, and then we get a push up the next day, so then that's a possible trade. This one here, we got this low here, we can see we just about take it with this candle, and then we move up to the upside. So these trades happen near enough every day, or maybe even every other day. It's just to be vigilant of what sort of trades we can actually take and if price is actually going to give it to you. So back to this example, we've marked out the high, we marked out the low. That's all we have to do on the daily time frame. Now we drop down to the 5-minute time frame and let's see what's happening. Now, as I mentioned previously, we want to be careful of where price is in terms of what session price is in, but when it takes the high or low. If it takes it during a very dead period for gold, then it's likely not going to be a good trade to take. So for example, if we look at price action on gold, we can see that the New York session is very volatile, right? We've had this move up, we move this down. Same with the Asian session, we get good moves during these two sessions. But during the London session, gold is generally flat. So as you can see, it's quite flat. There's not much volume here. Again, not much volume. Towards the end, we get something. And that's a general pattern when we're looking at, you know, the London session compared to the Asian session compared to the New York session. So we're going to be bearing in mind what session we're in when looking to trade this. But let's just play price action and see if it takes the high or the low first. So straight away, we've taken the low. The next thing we're going to look for is, did we get any significant structure when price was moving down? No, right? We're on the 5-minute time frame. No, it's just price moved down. We stopped for one candle move down. That doesn't count as structure. So now we know that the entry model we're going to be looking for is this type thing, right? Where price wicks in, wicks out, and then we're going to try and enter over here. So that's what we're going to be looking for. So there's the high that looks like it's been put in. Let's just play for a bit. What we're now looking for is a higher high than this one. So let's wait for that to come in. Okay, there's the higher high. And now we're looking for a fair value gap in this move up. And we can see we've got this one here. So I'm going to go from here to there and just pull it to the right. And very simply, it's super easy. We're just going to put a entry here, stops below these two lows here, and then we're going to target a very nice 1 to 5. There you go, nice and perfect. Let's play. Okay, we get entered here. Let's just move this to the left, and then we should get a really nice strong move to the upside. Boom, nice easy 1 to 5, and as you can see, you would have got a 1 to 3 even quicker as well. And that's a really good example of this trading strategy in action. And I'm not going to go over another one because it's very simple and there's no point me going over 2 examples. But again, thank you for watching this video, and I'll see you in the next one.